Traders are always looking for the holy grail, that magical system that will guarantee profitability. And other traders will basically come and say, hey, every single strategy works. So wherever you lie on that spectrum, what I want to do is give you 3 actionable tips. And if you focus on these 3 things, it will make your trading faster, more reliable, better risk to reward, and therefore overall better profitability. So in line with the motto of this channel, a restricted trader is a profitable trader. I believe that adding restrictions upon yourself is not to limit you, it is rather to protect you. And therefore, if you are to take the time of day as an example, I'm sure you can imagine there are better times to trade and worse times to trade, but we need to understand when is that time of day where the major moves of the market, those new higher highs and those new lower lows, what time do they start? And that is going to be number 1, your London Open. The London session is where the major participants of the EU, therefore Germany, France and the UK, become active. And usually what happens, by the way, is the Asia range, which is not the most volatile moment of the day, is usually a form of consolidation. So therefore, when the London market opens and the Frankfurt market opens, usually you're going to have a sweep of liquidity of the Asia range. You're going to start your day with a manipulation. So manipulation plus time equals movement. You know, in the movie The Matrix, where you have the girl in the red dress, and no matter how enticing it may seem, it is always going to be a distraction. And therefore, I would say avoid Asia range altogether. So my first recommendation is, if you can trade the London Open, convert it to your time zone, and say that first 1 hour window plus or minus a 10-15 minute buffer is the exclusive window I can trade during a London session. And secondarily, if you trade the second hour of New York Open, you are capitalizing on the New York Open manipulation and therefore getting either a New York reversal or a New York continuation. So therefore, these are the 2 exact hours of the day that I recommend you trade, and anything in between, disregard. And at times on a short-term horizon, you might have a good trade that plays out, but it happened in the 3rd hour of the London session, and that is going to be the lady in the red dress. But what we have to also remind ourselves is we need to judge our strategy on a 100 or 1000 trade sample size, and therefore these small missed opportunities on a short-term perspective, it will be annoying, but on a longer-term perspective, it will always be in your favor. And 3 years ago, I switched my strategy to be only trading in these time windows, and it certainly increased my profitability. So therefore, no matter what strategy you have, if you're trading at the right time of day, you're protected from the fake moves, and you're making sure you're entering the market in the most meaningful, volatile moment of the day. And by the way, if you look back on all of the case studies that I've had on this channel, remember from my public signals, the 7 months of live callouts with the entry, stop loss and take profit levels, every single trade that I gave that led to 50% profits over the 7 months was utilizing these key time windows. And I've given exact trade breakdowns explaining why and showing example after example after example on how the meaningful move of the day was within the key time window. And if you were entering before or after, you would have actually got the market wrong. The next drag and drop confluence that I want you to focus on is lower time frame modeling. Now, whether you are a higher time frame market structure trader, whether you are a smart money concepts trader, whether you are a Fibonacci and trendline trader, all of these approaches are going to give you ideas that I want to enter upon this region. Based on this dynamic trend line, I want to be entering upon here. And what I found is majority of schools of thought, they'll give you zones, they'll give you probable areas, but we have to have a difference between what we think can happen versus what is justified to take a trade. We can have feelings of the market might do X, Y, Z based on what we've seen, but it might still be a low probability trade, and those differentiations are going to be our rule sets, and they're going to be our restrictions in our trade plan. And I think one of the most powerful ones is your lower time frame confirmation types, because you can have a zone, you can have an idea, but you need to know how to accurately execute that idea in a controlled and sensible way. Now, a lot of people will have a lot of opinions on how to do this. Some people like market executions, some people wait for a candle formation and enter on the candle close. So take it from someone that has tried it all and tested every single lower time frame modeling that exists, utilizing large stop losses, utilizing small stop losses, even going down to the 15-second time frame. And what I found is it's a balancing act between understanding precision and accuracy. And by the way, they are not the same thing. Precision is timing the market and entering exactly when it reversed. Accuracy means whenever we enter the market, we get it going in our direction. We might have to hold the trade for a bit of time, but 9 times out of 10, it will be in our favor. It might not be a precise sniper entry, but it was an accurate entry. So what we need to do with our lower time frame modeling is be protected, be accurate, and be precise. So of course you need to focus on risk management. Don't over leverage, have a risk management strategy. But assuming that is in place, how do we balance these three things? So therefore, out of all of the lower time frame modeling that I have, the most reliable one, the most profitable one, and the most repeatable one, because it is objective, is a simple 5-minute break of structure on a valid zone. And especially if you add it into the key windows that I just gave you, you're going to be entering on the most reliable moment of the day with the most reliable rejection type. Now, for example, if you utilize, let's say, a doji pattern or a morning top pattern, you'll realize that these are great ways to trade. These are great ways because they are showing you when the market is showing an impulse, exhaustion, and then going in the opposite direction. But what is truly going on the lower time frame? So utilizing either the 1-minute or 5-minute time frame, if you can see internal bullish price action presenting on M1 or M5 coming into your valid zone, and then it enters your key time window, and then you see higher high, higher low, higher high, and then lower low. The market goes lower and does a clear full break of structure. Then you know you have had a form of rejection. And if you are entering at the right time of day, you are entering at the right zone, and you have found that right rejection, then you simply take the refined IFC that I've spoken about on this channel. Then you have an exact place to set a limit, you have an exact place to put a stop loss, and therefore you will have on average, utilizing this break of structure on an M1, M5 time frame, more often than not a stop loss between 2 to 7 pips. Now, the reason that this is important is because if you are entering at the most volatile time of day, at the most reliable zones, utilizing a key rejection, you might get the market wrong from a directional bias. And to be honest, that's out of our control. Our job is not to know where the market will go. It is to enter on reliable zones. So if we know we are entering at the right time, at the right place, in the right way, and we can just get a reaction. If we have a 5 pip stop loss, a 7 pip stop loss, this is not abnormal. In fact, over the last 60 signals that I gave, my average stop loss was 4 pips across 60 trades. And if you think about it, if you're trading a London Open on a GBP USD, achieving 15 to 20 pips, which just could be a movement to go to the next demand area, to grab liquidity, whatever it may be, you might have got the direction of the market wrong from market structure, from the rest of the day, the rest of the week. But if you capture just the session volatility, you can achieve a 1 to 3 risk reward rather easily. And what's interesting for me, and the reason I recommend this for your own trading type, is because out of the 50% gain that I gave over the last 60 trades in my public signals, over 50% of that profit, meaning over 25% gain, was done from these 1 to 3 risk reward partials that I was taking. And then those trades maybe even went on to hit break even. Maybe I got the direction of the market wrong, meaning to say I was not accurate in my trade idea, but because I had good entry models, I was able to capitalize on the market simply because of the lower time frame modeling. So no matter what type of trader you are, no matter what strategy you use, if you can enter with precision, accuracy, and controlled risk, you will always be able to capture a small impulse based on session volatility. And as long as you break even and protected, you will always be able to capture a nice 1 to 3 risk reward if the intra-session reaction is there. Now, just as I mentioned previously, as a trader, our job is not to optimize for an individual trade. It is to optimize for a 1,000 trade basis. So therefore, we have to be void of emotion. And my objective approach, my recommendation is, if you are taking an entry based on a 1-minute or a 5-minute shift, for example, that bullish price action leading into your zone, and then that break of structure that you have. When you have that break of structure, you enter on the retracement. The moment you have a continuation in your direction, you break even once a new lower low is made on that 1-minute or 5-minute time frame. We're not going to wait for price to go to a certain target level, because that is trading from hope. That is trading from a perspective of, I want to leave my risk on the table just in case it goes lower. So rather have an objective one, don't mess with it. If it starts to come close to it, don't remove it. Just have that mechanical objective break even protocol upon an M5 or M1 market structure shift. And my last most important drag and drop feature, if you can implement this into your trading strategy, and only this, it will be the most powerful one, and that is identifying the inducement of the day. Now let's break this down into its key components. First of all, what is an inducement? An inducement is quite a in-depth topic. There's a lot of things to understand, and there's a lot of types of inducements: major, medium, and minor. And within these categories, there's many subsects also. So rather than me trying to explain everything right now, what I'm going to say is let's focus on a major inducement and understand the key features on how to identify it. So the best way to understand an inducement is think of it as a meaningful run of liquidity. And if you're an SMC trader, it's not the typical sweeps you see. An inducement is a formation that entices people to get in, falsely traps them, and then takes them out. So it's not just a stop loss hunt, it's a full trap mechanism. And the reason this is important is because we need to understand the market moves based on liquidity. If there's no pending orders and manipulations, the market will just be flat. The essence of the market is liquidity. Now, as you know, market goes from A to B. Let's say the market makes a new higher high, a bullish impulse, and maybe on the daily time frame it looks like it's straight move. But if you go down a lower time frame, you'll see that there's internal price action. And if you go down even lower time frame, you'll see there's even more internal price action. Every single meaningful impulse in the market will be utilizing and having an inducement within there. Whether that's medium, major, or minor, there will always be an inducement there. And you can peg it to certain things. For example, an inducement usually is in a reliable point of interest, a strong and valid demand area or supply area. Additionally, you will see that these inducements are happening on meaningful times of day. So you might arrive to a valid demand area, you might have price action starting to reverse, but it's the Asia session, and you'll realize that that fake move during the London session will get induced and then the real move will happen. So you start to realize that traps are building around the reliable zones in the reliable way. So you cannot rely on just valid zones, you cannot rely on just Fibonacci levels and trend lines, and you cannot rely on only lower time frame confirmations, because if you're missing the inducement of the day, you're always trading blind. So the inducement of the day, the best way to think about it is a domino effect. Once you set off that first domino, the cascade of the following dominoes will always fall. So if you identify the inducement of the day and you've identified it's a bullish inducement, you know the rest of the day should go bullish until the liquidity dries up. So if we are trading with a major inducement, no matter your approach, if you are trading a Fibonacci level or a trend line level and you enter after the inducement of the day, you're always going to be in the right direction of the market. If you're trading a supply and demand zone and you wait for the inducement of the day, you wait for that domino to fall, then whatever way you enter the market thereafter, you're always going to be trading with the right way of the market. So let's break down exactly how we can identify these inducements, specifically the major inducement, which is the one of the three things I want you to drag and drop into your strategy to definitely improve that approach. Okay, so let's imagine we have price action looking like this, where we have a bearish market structure where we are forming lower low, lower high, lower low, lower high, lower low. So we've established a bearish market structure trend like so. So therefore, what is the natural thing to do? It is to orientate yourself looking for sells. Now, there's many ways you could do this. You could say this is a support level, it turned into a resistance level, so therefore this range over here is the area I need to be looking at. That's support to resistance approach. That could be one way. Another way could be you utilize market structure, supply zones, order blocks, and you say this is the last area that made the lower low, therefore I'm going to identify this as a supply area. The next approach could be, for example, utilizing a trend line where you say that these are the touches of the market. You have one touch, two touch, third touch, and then the fourth touch happening here, so therefore you look to sell. The next approach could be a Fibonacci level, pulling a fib from the full retracement to the zero. You could say that the 61.8 or the 70% fib is within this region. No matter what strategy you use, you could do an Elliott wave count, you could use indicators. There's many ways to identify zones. There's many ways to identify trade ideas and zones that the market can reverse. But if you just enter on this zone randomly and put your stop loss at the high, you can do that. But the problem is you will have no precision, you'll have no accuracy, and therefore your risk to reward will be rather low. So rather than just entering in these random zones and having a large stop loss, that's when you take the first 2 points I mentioned. Time of day. If you're entering at the right time of day, you know that you're going to have the meaningful move most likely. And therefore you know that you don't need that excess area above. You can just find the time of day, the high of that time of day, and put your stop loss there. The next thing is the lower time frame models. So if you have the right time, the right zone, and the lower time frame modeling I just discussed, you're always going to be in the right time, in the right place, in the right way, in a controlled way with precision, accuracy, and reliability. So the last thing we need to add is the inducement. And this is going to bring everything together. And just to show you an example in the diagram, the liquidity cycle, the inducement cycle, follows this process of build up, inducement, mitigation. So if we follow that process, we can see it's happening on a lower time frame where we have the build up, inducement, follow through, build up, inducement, follow through, build up, inducement, follow through. And this will be a repeating pattern you see in the market. Remember, as I said, if you go down lower and lower time frames, every meaningful move, you will see this formation, build up, a run of liquidity, and then the follow through. And that digital signature, that footprint that we identify, are zones are for us to enter. So with that in mind, we can utilize this run of liquidity that leads to the lower low. We can take that area as a supply zone. So as price is entering that supply zone, we zoom in and say we've identified an inducement type of supply. Now we need to wait for the time of day. So then we'll wait for, let's say, our London window, our London open, the 1 hour trading window that I gave, and we're waiting for price to get into that zone in this key window. But one thing that we need to gel everything together is an inducement. So we can see that there is multiple zones that could get induced. For example, within here, we have our Asia range. So if price breaks out, we sweep that Asia high liquidity. Next, over here, we see minor supply zones, minor structural levels. We can see all of that getting induced. But a major inducement is a major structural point. Now, the reason this is going to be powerful is because the amount of liquidity that is taken during a major inducement. Think of it like this. If we have this major supply zone right here, there's going to be many stop losses that are going to be in this area. No matter the execution type, maybe it's a lower time frame candle, maybe it's a lower time frame breaker structure. Whatever whatever the case may be, there will be an abundance of stop losses all the way in this area. So if price shoots up, we're going to take all of that liquidity. So we know in major zones, there is major liquidity. And more often than not, these areas are respected. So therefore, the fallacy becomes, if this is always respected, this is always true. That is the narrative of the inducement. That is the narrative of the manipulation. Second of all, what happens when the market starts to shoot up? We break this level. Now, certain traders are going to think, oh, the market has now made a bullish break of structure. We've taken out a supply zone. We've taken out the last lower high that made the lower low. We've had a bullish break of structure. What does that mean? People are going to be entering buys on this area. You're going to have breakout traders triggering on this zone. We're going to have bullish market structure traders. You're going to have reverse Fibonacci traders. You're going to get all of these new players getting into the market. So not only did we take all the stop losses of the sellers, we also invited a lot more buyers. So when we get that formation, the best manipulation can be a major inducement where you take the stop losses of the sellers, you invite the buyers, and then you take them out too. So the buyers got taken out, the sellers got taken out, and that is a full inducement. If this is on a major structure point, anything above the 1 hour time frame, a supply zone or a demand area on the 1 hour time frame and above, getting induced like this is going to be the most powerful inducement of the day. Now you add it in with everything I've mentioned in this video. Time of day. If you can get a major inducement like this that not only manipulates Asia range, not only manipulates small areas on the left, but manipulates major zones. If you're getting that major inducement during the London window with the lower time frame confirmation type, you will always be at the right time, in the right place, in the right way. And what usually happens after the inducement of the day, price will not just go down in one move. It will have the domino effect that I mentioned. So price will start to go in your favor. Maybe you have that 5-minute break of structure, you enter on the IFC, and then you have your break even right here upon the market structure shift within your key window. Now, as the market starts to go lower, you'll get build-ups, inducements, and then price going lower. So this continual build-up inducement reaction is going to confirm and reaffirm the direction, the next domino and the next domino and the next domino. So if we find the inducement of the day, and we can accurately find that, and then we find all these follow-up inducements, build-up, inducement, mitigation, and then for follow through, these will all reaffirm the inducement of the day. So if we miss the main inducement, if we miss the main move, we have follow through opportunities as long as you know how to identify the follow through sequence of inducements. And all you have to do is find the inducement of the day, find the follow through inducements, find the time of day to be trading, and the lower time frame models to be entering upon. If you can do all of these three things correctly, which is not so hard because it is mechanical, and add this into any system, it will certainly improve your trading. So therefore, as I always say, a restricted trader is a profitable trader.